Hello, I am Melissa Wade for Northern State Financial. In this message, Alan Grodin invites Bryan Duffy of Genworth Financial to talk about new strategies for volatile times.
The market collapse of 2008 and parts of 2009 were like no other in my lifetime. I've experienced a number of down markets, and diversification helps smooth the ride for most portfolios. This time, those non-correlated assets, such as real estate and commodities, fell right alongside the more traditional asset classes. We can't say for sure whether or not this will happen again. However, it makes sense for us to question our assumptions and look at alternative strategies that hope to provide protection as well as performance. With that in mind, I've invited Bryan Duffy of Genworth Financial to discuss some newer approaches to asset allocation discussion. Bryan, traditional buy and hold strategies suffered dramatically in the last downturn. Are they outdated and of no value?
I think it's probably the most pressing question that our industry and clients and advisors alike have been asking. The quick answer is no, Alan. The more expansive answer is it depends. If you think about the market lows from March 9th of this year, the traditional buy and hold approach would have rallied very, very handsomely. If you think about prior market environments where returns are easier to come by, think of it as a bull market, if you will, traditional buy and hold approaches tend to outperform other approaches to the asset allocation decision. Unfortunately, they don't work best all the time. There are other kinds of market environments where that approach will not perform as well as some other approaches. Let me give you a couple of examples. If we think about the sell-off beginning in 2000 of October through March of 2009, a buy and hold approach would not have delivered very good returns. A more active, more risk-aware approach would have dramatically outperformed. So it doesn't perform as well in that singular market down a lot event or environment. It also doesn't perform as well in a more protracted secular bear market environment.
By secular, you mean long-term?
Secular is long-term. Typically 5 years or longer. The Wall Street Journal calls the decade of the 2000s the lost decade. And they refer to it that way because market indices going back to January of 2000 were higher than where they are today. If you look at the Dow, the S&P, the NASDAQ, we've made no progress over what's now a 10-year investment time horizon. So that singular market down a lot environment, the traditional strategic buy and hold approach traditionally will not perform very well. And in the middle of a more protracted secular bear market, they tend not to deliver the kind of results clients are looking for either.
So what are the alternatives?
There are a couple different ways to think about the asset allocation decision. The reality is clients tend not to have the 30 to 40-year investment time horizons that big pension plans and institutions do. When you think about how markets actually come about returns, it makes sense to slow down and take a much shorter term, more granular view of how markets actually deliver returns on a year-over-year basis. In doing so, you need to think about how you're controlling risk in those environments. When you think about an asset allocation approach, the long-term buy and hold approach is oftentimes called a sailing approach. The market's delivering a very nice tailwind for you. You can build that allocation and let it ride for a good period of time. Other kinds of markets, you need to be much more active. We think about those as rowing markets. We've got a very strong headwind that we're approaching. And the two allocation approaches that tend to work best in those environments tend to be what's called tactical unconstrained asset allocation, meaning you're not pouring cement around any predefined initial allocation decision. Your manager or strategist has tremendous flexibility and leeway in terms of either moving to cash or increasing what might be an equity exposure. That's another way to think about it.
So conceivably, a manager can go from 100% stock ownership to zero.
They could.
Under certain circumstances.
They could, under these new approaches. Yes, absolutely.
So when they do that, they get out of the market. How do they know when to get back in?
Yeah, it's a very, very interesting question. Typically, the decision that would drive their exit from the market is based on any number of criteria. It could be based on valuations. It could be based on sentiment. It could be based on flows into the marketplace. So whatever their toolkit is that they look at that made the decision to exit the market is predominantly the same toolkit they would look at, but having reversed in terms of a more positive outlook moving forward. So they would look at valuations, they would look at momentum, they would look at sentiment as an example, and when those became more attractive, that would then drive a decision to re-enter equity markets.
Understood. And what about for the more conservative investor that would get a little uncomfortable with that kind of wide swings of asset?
Sure. I think the final approach to an asset allocation decision is called absolute return. What's very different and interesting about an absolute return approach is how they define success and how they keep score, if you will. They'll define success by delivering a positive return in any single calendar year, independent of what's happening in the interest rates markets or in equity markets. To do that, you need to take a much shorter term approach and need to think about how you're managing risk in that environment.
Couple questions. This type of approach wouldn't outperform markets in a positive environment.
No, certainly would not.
And what kind of instruments? And typically we think defense and we think about bonds.
Sure.
What other types of instruments might they use to control risk?
Yeah. I think it's a very good question. So number one, the toolkit they get to use in the allocation decision is much broader than traditional asset allocation approaches. That toolkit could include being both long and short the markets. It could include a market neutral fixed income piece.
By short, you mean that they make money when the market goes down?
That's exactly correct.
Right. Okay.
It could include market neutral pieces, and it will include less traditional asset classes. So greater use of alternative asset classes that tend to perform well when the larger equity environment is deteriorating.
Well, thanks a lot.
My pleasure.
These strategies are of no inherent value in and of themselves. Just as the surgeon doesn't favor one instrument versus another, we must look at every situation and time frame as unique and work to deliver the optimum solution each and every time. Till next time.